So I had this conversation with a client recently, as many of my podcast episodes start with some type of conversation or question from a client or for somebody listening. And what came up was this fear that taking money out of his business would generate a tax bill or cause more taxes to be imposed on him. And what I realized was there's a common misconception that if you take money out of your business, that you're going to end up paying more in taxes. And it's actually not true at all, depending on what entity type you have. So I want to explain to you, depending on what type of business you have, what the implications are if you take money out, how to take money out of your business, and why it matters how you do it. So first off, most of you listening are in the bucket of sole proprietor or single member LLC, I would guess. So if you are an LLC owner and you are a single member, or you do not have an LLC, but you are a sole owner of your business, then you would have the simplest approach to taking money out of your business. And that is you only take what are called owner's draws. You are going to take owner's draws out of your business by simply moving money from your business checking account to your personal checking account. That is all you have to worry about. Simple. And what you have to keep in mind is just cash flow. So you don't want to be bleeding your business dry and taking all the money out so that you can't operate the business and pay your expenses out of your business bank account. So that's the biggest consideration for how much money you can take out of your business. Because the question I always get is, how do I take it out? And then the second question is, how much can I take out? And I say as much as you want to within reason, but you have to know how much money it takes to operate your business for a given month or two. So if you have expenses that amount to $5,000 a month, then I probably wouldn't dip below having 15 to 20K in the bank when you're early, because you want to have a few months of expenses in the bank account and not spend them. Not to mention, you have to take into account that you have to pay taxes. So I would include in that money, when you take money out, set aside some toward your taxes. Now, when you get taxed as a single member LLC or a sole proprietor, you are not taxed on the money you simply took out. You're taxed on the profit, whether it's in the business bank account or it's not. So all you're doing when you take money out and you call it an owner's draw, you're not reducing the profit. You're not changing the outcome tax-wise. All you're doing is geographically moving some of your profit from sitting over here to sitting over there. And the IRS doesn't care where it's sitting. As long as it exists, they're going to tax it. So what a lot of people do is they make the mistake of distributing or taking those draws, and they take the draw and they neglect to realize that money is part of what's used to pay taxes. That's part of your profit. So because that's part of your profit and you're taxed on the profit, most people get caught with their pants down, in a sense, at tax time because they take money out to pay for personal expenses, but they don't factor in that they have to set aside some for taxes. And then they're stuck with, oh my God, I spent all that money already. I already spent it on personal stuff. I went shopping. I paid my rent. I paid whatever. Oops, I didn't save for that. Now that's another episode, like how to save for taxes. We want to make sure we're doing that. But when you take money out of your business, it does not trigger any new taxes. You are still taxed on the profit. So if I use an example, if your profit is $50,000, then you are taxed on $50,000. Now, how you're taxed and all that's, again, more complicated, but that is part of your income. The $50,000 from your profit is part of your income. Whether you're married, filing jointly, whether you're single, that's all part of your overall tax situation. It's passed through. So that 50 grand is sourced from your business. But it's all going to get poured into your overall personal tax return. Now, it doesn't matter if that 50 grand is still in the business bank account. It doesn't matter if you've taken all of it out. It doesn't matter if you have no dollars in the bank account. It doesn't matter if you have taken 20 grand out and spent it on other stuff personally. You're taxed on 50 grand. So you have to make sure that you are mindful of that and that you're not creating any additional trouble for yourself tax-wise. In particular, this client was struggling with this because he had a very similar situation. He was an S corporation, and an S corporation is very similar. S corporation is almost exactly the same. Now, assuming you have a single owner. If you have a single owner S corporation, it is exactly the same. You're taking money as an owner's draw, and you're going to be factoring in, okay, well, can I afford to take that much money out? And you have to be ready for the taxes because it's also a pass-through entity. Now, there's another nuance to S Corp, is that there's another way to take money out, and that is to pay yourself a salary through payroll. You cannot pay yourself a salary through payroll in a single member LLC or a Schedule C sole proprietorship. Until you have an S corporation election or a C corporation, you do not pay yourself payroll as a true W-2 employee. So if you're talking about setting up payroll for yourself and you don't have a corporation, that would be an incorrect approach. Okay. So you want to make sure that if you're an S corporation, if you've made the S corporation election, that you have yourself enrolled as an employee on your payroll, you are paying yourself that payroll, a reasonable salary, whole separate episode, what a reasonable salary is, but you're paying yourself a reasonable salary, but you're going to get that money in the form of a paycheck like you would working at McDonald's, okay? You're going to get a paycheck like a regular employee, and you're going to get that net pay, and taxes will be taken out and withheld, okay? So you can take money out of your business by paying yourself through payroll or as an owner's draw. Now, how do you know which one to do? Well, my advice, I look at this like, I use this analogy all the time. Like if you're hungry when you were a kid, you go, Mom, I'm hungry. I want a cookie. And they're like, if you're really hungry, at least this my mom did. If you're really hungry, go have a carrot. I don't want that though, but you said you're hungry. That would solve the hungry thing. Or do you just want a cookie? And it's like, we totally just want a cookie, right? We want a cookie, but we say we're hungry. So how the IRS views this is if you can afford to take money out of your business, they would prefer we take salary through payroll. Why? Because they get extra taxes out of it. They pay more taxes on every dollar of salary than we do in owner's draws. So that is the least advantageous way to take money out. So, okay, we have to pay. So the rule is basically you have to pay a minimum amount. You have to pay a reasonable amount. Now, do they give you how much that is? Hell no, they don't. They do not give you any sort of guidance, and it's a pain in the butt because us accountants have to then go figure out what your reasonable salary is using our judgment and some type of method that we develop. Now, we have that method. I have a way to do that, and I've helped dozens of entrepreneurs, if not hundreds, do that. But the IRS is not explicitly clear on how much money your salary should be. So as a result, we end up, estimating, we guess, and we say, okay, we believe this is reasonable. We can support this number if we ever have to argue why you're paying yourself this salary. Cool. Once you have paid that, I look at linearly, like once you have paid that, you take extra amount in draws. Now, can you do them simultaneously? Absolutely. This is what I do in my S corporation. So I pay myself a nominal salary of about $9,000 a month. And I'm not telling you you should do this. I'm telling you that is what I have come up with based on all of the factors we consider. I pay myself $9,000 a month in salary. Now, if I need more money than that for particular projects, investments, something else where I have money in the business bank account, but I myself don't have, I don't have the money personally and I need to pull from the business, I take a draw. Okay. I don't pay myself an extra payroll. I am on track to hit my reasonable salary using that monthly rate. So as long as I'm doing that every single month, I'm golden. I have eaten enough carrots where I can ask IRS mom for a cookie. Get it? So I am satisfying the IRS's, need to have me pay a salary. And then extra, I can go take out extra money if I need to because I'm doing all of my homework. I am doing my salary. I am paying what they want me to pay in payroll taxes. So because of that, I can then go the extra mile and say, okay, I'm going to go take out more money because it's my money. I can take it out when I want to. So can you. But when you take the money out, you're going to take a draw only if you're already on track or have paid yourself that reasonable salary. That is the rule. So there's two ways that you can pay yourself as an S corporation owner. Now I'm going to jump over to partnership. So if you are a partnership, and believe it or not, most cases where I discuss this with partners, they don't even know they're a partnership. So let me explain what a partnership is. You are taxed as a partnership, even if you haven't called yourself that. If you are a LLC with multiple members, multiple owners. So if you got together with your sisters, your cousins, your friends, and you formed a business entity together, that is a partnership. So if you haven't elected the S corporation election, if you haven't done anything extra, you are a partnership. So if that's the case, let me explain. There are a couple of ways that you can get paid. Now, do not put yourself on payroll unless you are a corporation. Do not put yourself in payroll. You can take those draws, we call them distributions in the context of a partnership more often. So partnership distributions, but you will have a partnership agreement in place with your LLC that will govern, that will dictate how each member gets paid and how much. So if you have, let's say you have a 4-person multi-member LLC. Those 4 people, let's say it's 25% apiece. That makes it clean. So if you have $100K profit, each of you will be taxed on $25K of profit. Simple math. However, if you don't distribute that money equally, like if you're not taking draws out in equal installments commensurate with your share of the partnership, then someone's going to get kind of screwed because you're going to pay taxes on the 25% that you own. But if you didn't take out that much when you did a draw, then it's uneven. This has happened many times with my clients before where they didn't know that they didn't know how to take money out fairly so that they could cover their tax bills because their tax bill is based on their ownership percentage versus how much they took out. So it gets a little bit confusing. You can take money out by doing a distribution. What I recommend doing is if you don't have the specific terms I'm going to talk about next around guaranteed payments, stay tuned on that. If you don't have guaranteed payments, then you're expected to distribute according to the shares that you own. So if you're 25% apiece, you're expected to distribute 25% apiece. So what I've seen partnerships do, and what my dad used to do, he was in a multi-member LLC. They would get together, the partners, and they would say, we're going to do a distribution every quarter at the end of every quarter. And we're going to distribute, let's say, 20 grand or 30 grand. Like you pick a number and it could be different every single time. It's fine. But if I say, I'm going to distribute 10 grand, well, guess what? Then that means we're going to take 10 grand out of the bank and here's your 2,500, here's your 2,500, here's your 2,500, right? So we would distribute it according to the shares that people own so that it was all fair in accordance with the shareholder agreement. If one person takes out 10 grand and the others take out 0, well, then one person just got $10,000 extra in their personal account and the others are going to be taxed on part of that. So that's not super fair. So what you have to do is be mindful of, okay, well, how much do we own? How much are we going to be taxed on? And is it fair to take out the money in unequal installments? Now, you might have a situation where the partners don't have equal share or you don't want to have equal payment. So let's say you have a partnership that's 50-50 in the share ownership, like you own 50%, 50%. However, one person does all the work. The other person is pretty passive. They're just like, they don't need any money out of the business. They really don't. Well, what you can do are these things called guaranteed payments. And the guaranteed payments work this way. If you put in your partnership agreement that you enable guaranteed payments, you really just talk to your lawyer, but you just need to add terms saying that this is a possibility. What guaranteed payments are kind of like a salary, but it's not payroll. It means that every single month, every single week, every single quarter, whatever you define, you are going to get a certain payment for the work that you're doing. So if you run, this actually happened with a client of mine, you're in a health and fitness business and you have a nutritionist, the personal trainer and the nutritionist are partners. Now, let's say that they have a certain amount of ownership of the business, but in addition to the distributions, the trainer says, we've also agreed that I'm going to take an additional $5,000 a month because I'm doing more hours in the business. Like it's not actually a 50-50 split, but because the distributions will be 50-50, I also want additional compensation for the extra hours I'm putting in. I'm doing 90% of the work and owning 50% of the business. It is possible for that scenario to be true. So if they say, hey, we've decided that I'm going to take an extra $5,000 in distributions every single month, that's called a guaranteed payment where you can get paid, one of you, and the other one doesn't have to also be paid equally or, in accordance with the shareholder agreement. So the way this would work is you would establish those guaranteed payments and then you would basically set it up as long as you're doing it. You actually have to execute on this too to prove that this is how you've set it up. But it enables you to take payments or take distributions off schedule, if you will, from what you normally would with a distribution. So there's another version of taking money out as a partnership. Lastly, C corporation. So C corporation, be very careful. C corporations, if you take money out, the way that it should exit is typically through an owner's salary. Now, we covered this with S corporation, that you would pay yourself a salary, reasonable salary. Go back and listen to that section if you own a C corporation. Everything I said about S corp was true, except do not take, quote, owner's draws if you can avoid it. Here's why. So the way C corporations work is there's this kind of thing that is a little stigma in the accounting world that C corporations have what's called double taxation. They are double taxed. They get you twice. Here's why. Because your profit of the C corporation is taxed at a corporate level. It is not passed through. So if you make $100K profit, you're going to be paying 21% effective as of now. We are in January 2024. This is what it is right now. 21% corporate tax rate on all that profit. In addition, if you take money out as an owner, that is treated as a dividend. So if you're paying a dividend to one of your owners, that is also income to the owner. So the same dollars, let's say it's $1,000 profit and a $10,000 dividend, the $1,000 profit is going to be taxed, or excuse me, $100,000 profit is going to be taxed with the 21%. So you're paying that already. Then you also paid, let's say $10,000 in dividends to the owner. That's another, let's just say ish 2,500 if it's a 25% effective rate. So that's another couple grand in taxes on the exact same dollars. And it's like, is that legal? Yes, it is. That's how the law is written. So if you have a C corporation, you have to be especially careful about how often you take money out of the business and how you do it. You're better off typically just paying the salary than necessarily paying the dividend. So you might want to just look into, hey, how am I actually paying this? How is this coming out of my business bank account? How is it routing to me? So that you're aware of these tax implications, because you want to be making sure that you're doing the right thing when you pay yourself. Now, like I said, most of you are probably in the camp of having a pass-through entity where you can pay yourself just through an owner's draw. It is so simple, it is so easy, and it's fine. There's nothing to be worried about. It's only when you get into like the C Corp territory, or if you're trying to figure out how much of a salary to pay yourself, that it starts to get complicated. Now, if you want to make the S Corp election, or you've made the S Corp election and you're like, whoa, this is new information to me. I didn't know I was supposed to pay a salary through payroll. I didn't know I was supposed to do all that. It's cool. Here's what I want you to do though. If this is like new information and you're wondering, hey, how do I do this whole payroll thing? Reach out to me. I would love to help you. I have plenty of tools available on how you can determine your reasonable salary, and we can actually help you come up with that. So send me a DM on Instagram. I'm at Shannon K. Weinstein. Let me know that you listened to this episode. And if you want to learn more about how to pay yourself properly, I can send you more information. All right. That's it for today. I'll see you on the next episode.